Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back. This is episode 195, May Market Update with Matthew Navickas. Matthew, thank you for joining me back on the show.
Yeah, thanks for having me again.
Of course, I think this is our second episode, right? So we're kind of rolling now.
It is. We're getting a nice rhythm going.
Yeah, and I would rather have you on the show when the market's up.
Yeah, unfortunately, we are not in that environment right now. We're dealing with a little pullback here for sure.
Yeah. So certainly. So today we're going to go over that. We're going to talk about what the Fed is doing and why. The most popular question I've been getting is, where do you think the market's headed this year? So you and I are going to talk about that. And then third, probably most importantly, we're going to talk about what we're doing about it. So what are we doing for our clients who have trusted us with their life savings to manage their capital? So we're going to talk about those three topics. But first, I wanted to congratulate you. You recently passed level 1 of the Chartered Financial Analyst designation. Super hard test, in my opinion. Why don't you tell the listeners or our audience a little bit about what that level entailed and what it means next?
So the CFA level 1, it was a very difficult test, and it looks at pretty much everything you can think about in the financial markets, how companies are structured, how to read a financial statements. So just a lot of great information to know. There's still a lot more work to be done and a lot more things to learn. So still have 2 more tests to finally get the CFA designation, but it was great to pass level 1.
Yeah, so congratulations to that. How long did you study? What was the prep time on that?
I had the material for 6 months or so and was studying for that period of time, but really studied hard for about 3 study months. So it's quite some time that it takes.
So it's not like college where you can kind of cram for it a day before.
Right, which I like to do, but I wasn't able to do that for this.
Well, good for you. Yeah, so we're real excited about that. You know, you and Abby Stockman are our 2 traders. You guys also do a ton of research for Corey and I. And so the CFA charter holder is comprised of 3 exams, right? Plus an ethics, and all of the signing off and all that. So it's not so much down the road of financial planning, retirement, or tax. This is really into individual company analysis, right? Which is great. So that's a second part of what we do at Falcon Wealth Advisors. One, we're doing the financial planning, tax planning, retirement planning, but we're also picking individual stocks and bonds. And so by you furthering your education in that arena, our hope is that you're going to be able to add that much more value to our clients' portfolio. So thank you again for taking the time. How long was the test?
What was it? I think it was a little over 2 hours long. It was 2 parts.
Wow. So all that studying for a couple hours?
Yeah.
And then you didn't find out for, what was it, a month or 2?
I think it was 7 weeks it took to get back, which I think is kind of a racket, but
I agree. Now, was it electronic or were you like filling in a Scantron?
It was electronic, but they do a really in-depth analysis on all the questions. And then that's the reasoning for why it takes so long. But yeah.
Were you typing in any answers or was it all multiple choice?
It was all multiple choice.
That's weird to me.
Yeah, I agree.
But don't they do it like on a bell curve or something, right? Doesn't so many fail, so many pass? Or
Yeah, I'm not really sure, and they don't let you know how they do the analysis, but it is on some sort of curve.
Got it. Well, nonetheless, it is considered the premier. When you're looking at financial markets, I mean, the CFA, again, this is all my opinion and probably yours too, but I don't think there's a better thing you could be doing if you want to manage individual companies. I mean, other than just getting experience, which you're obviously doing that as well, but I think furthering your education and going deeper is something that's huge, and you're doing it for yourself and for our clients, which thank you again for doing that. So So let's try to apply some of that knowledge, right? So you got
Right.
all that brushed up. So we'll start off here. Recently, as of the recording of this show, we're recording this on a Friday morning. This week of the recording, the Fed raised interest rates 0.5%. Now, maybe you can talk to that a little bit about what was the market expecting, and what did we hear from some of Jerome Powell's comments regarding the Fed raising rates?
Right. So we did see that 50 basis point increase, and the market was actually in between a 50 basis point increase or a 75 basis point increase, which would have obviously been worse for the market. So what we saw after that announcement was a rally in the market. It was a pretty aggressive rally. So the market really liked that commentary that we had from Jerome. He also stated that he does not expect or foresee the need for a 75 basis point increase in the near future, which is also some really good commentary, because I know currently the bond market still is factoring in around an 80 to 90% chance of a 75 basis point increase. So there's still quite a bit of, I would say, pessimism in the market right now, and still some uneasy investors thinking that, when interest rates increase, valuations will become a lot more difficult for the equity market.
Right. So a lot of people are wondering, why is he doing this then? Right.
So why he is doing this, and it is needed. I know it's not fun to see our stocks go down, but as they do increase interest rates, the valuations, as I said, will become more difficult. The reason they're doing this is because inflation is out of control, really. I mean, just from all the stimulus we've received, all the supply chain issues, whatnot. I mean, that's the inflation. I think read in March was at 8.5%, and I know the Fed's targeting for just over 2%. So we're well above that. So that's what they're trying to do now. They're trying to bring back and cool down inflation, while not sending the U.S. economy into recession, which is going to be a very difficult line to walk.
Right. So people and consumers can kind of rest a little easier knowing that, we don't like rates going up, but there's two things that hopefully this will benefit. One, hopefully the price of goods and services will stop increasing at this dramatic rate. I mean, gasoline's really high now. Groceries are up, right? So by the Fed raising rates, the hope is that some of that stuff stops raising at the rate that it is. And two, hopefully savings accounts will start paying you interest, right? CDs will come back into popularity. Bonds, while they're down initially in value, if you're buying new bonds, maybe you'll get paid a higher interest rate for that. So you're right. I mean, I think what he's doing is a good thing, and I don't like the stock market down, but that's what has to happen. I mean, when COVID broke out in 2020, I think they did the right thing too. They dropped all the rates. They started stimulating the economy, the marketplace, to keep things going. And if we look back, the markets had a great run during a pandemic. So the reality is, it's gonna be tight. Do you want it tight when the whole world is facing a horrible health pandemic, or do you want it tight after the fact when things are settling down from COVID's perspective, but now the economy is out of control because we primed the pump? It's like, you can't have your cake and eat it too, right? Unfortunately, it's just not the way it works, right? I mean, you can't eat a whole pizza without feeling bad later. And so now the Fed's like, get on the treadmill, right? Tighten your belt, literally. And they're removing some of the stimulus out, right? They're raising rates. And, the funny thing is, I mean, even for me, I mean, I was born in 1981. We haven't had issues like this since the early 80s, right? So it's been a long time. When was it when we had inflation this high? Do you know that? I mean, and if you don't, that's fine.
I'm not sure, but I was actually looking at some of the rate increases that we have seen from the Fed over the years. And actually I think it was May 1980, we saw a 5% increase in one meeting from the Fed. And we just saw a 0.5% increase. So we're still in a good environment. I mean, rates are still historically low. The market can still, find its footing here, and I think be able to rebound.
Right. Right. So that's the old mantra is don't fight the Fed. They're doing it for good reason. The markets don't like it because, like you've kind of alluded to, when you have higher rates, it's harder for companies to justify their valuations. And so it's a repricing. Isn't that what it, so like these excuse me, these multiples were expanded and now they're just getting contracted because rates are higher. Do you want to elaborate on that a little bit or?
Yeah, I mean, I could go into depth on this here, but I think the easiest way to think about it is that, you know, there are US Treasuries, and that's kind of closely what people use in valuations. So as the Fed increases their interest rate, their Fed funds target, you know, Treasuries are likely to follow. So investors are able to go out and essentially buy a risk-free investment. So they could go out and buy a 2-year, which is above 2.5% currently. So, I mean, that right there is just showing you that instead of putting your risk into an equity, you can go ahead and buy a risk-free bond that's going to pay you 2.5% for 2 years coming. So that's just something that valuation models will factor into the prices for these companies that they're valuing. So yeah, the really expensive, high multiple, or even pre-earnings companies are really being hurt hard because they actually don't have any future cash flows currently. So that valuation, that risk-free bond is a lot more attractive than those really expensive stocks that we're seeing that are being hurt really bad.
Yeah, thank you. That's a really good explanation, and I agree with that. And that's what's happening now. Credit to us before I go into what we're doing, but not that we knew. It's not like we were claiming to predict the future, but you know, we had a meeting early in the year, and we repositioned our portfolio really just for a pro-inflationary environment. And we tried. Yeah, we have some of these high flyers in the portfolio, but that's just part of being diversified. But we weren't chasing it like many other money managers or investors were. So we weren't overexposed in some of these stocks that didn't have the earnings support. And that's why our core portfolio for most of our clients has actually held up rather well, relatively speaking, to the major indexes because we weren't chasing some of these hot stocks. That's credit to us, right? Got to pat ourselves on the back. And again, not that we knew what the Fed was going to do or Russia and Ukraine or any of that stuff. It's just like we were saying, hey, inflation is presenting itself. Let's make sure our portfolio, our core portfolio, is set up to weather that storm. That was a simple conversation I remember having with you. And so, and Abby and Corey, I believe, was involved in that, or if not, Corey's certainly been involved with it a lot more lately. So my number one question, moving on to our second of 3 topics today is, well, first, quick commercial. If you're not already subscribed to Falcon Wealth Advisors on our YouTube, Falcon Wealth Advisors Collective, please do so. If you're listening to this on your favorite podcast platform, thank you again. Subscribe there as well. Thumbs up, like, 5-star if you think it's worthy. Share our content. That's what we're here for. Clients ultimately choose to work with us to enhance their financial literacy and explain exactly what their financial plan means to them. That's the whole point of today's show also. Okay, so the number one question I've been getting lately, Matthew, is where do we think the market's headed for the rest of the year? So what are your thoughts on that? How would you answer that if a client asked you that? And I'm sure you've had that conversation, or if not,
Right.
it's coming.
I would, in my personal opinion, I see there is, as I said before, a lot of pessimism in the market, a lot of negativity for the right reasons. Inflation's high, the Fed's hiking rates. We all know that, though. That's factored into the market. And I think even more, as I said, the bond market is factoring in an 80 to 90% chance of a 75 basis point hike. So I think there's even more negative information factored in that may not come true. So I think after, you know, the market gets its footing here, even if it sees cooling inflation, that'll be big. And also if it sees the Fed follow through with what Jerome Powell said of no need for 75 basis point hikes in the near future, I think we can get a pretty nice rally here. But I think currently we'll see some choppiness throughout the year here. But I would be inclined to say it's a good time to put some money to work.
Yeah, good. Thank you. And that's a good point. I mean, you know, there's still a lot of uncertainty. We also have the war with Russia and Ukraine. We've got COVID still presenting itself, China having issues with that. You know, we've got a looming tax bill, and then we've got a midterm election on top of everything you just said. But you're right. I think if the Fed follows through with what they said they're going to do and inflation numbers start to pull back, you're right. That would be a really good indicator. Ultimately, earnings are important as well. So, we're kind of in the tail end of earnings season. So hopefully in July and October, when we have earnings coming out again, that those companies are adapting, pivoting, and making good decisions and making money in the current environment that we're in. But I love that comment. You're right. The problem with market timing and individuals wanting to get in or get out is it's a fool's game. And like you just mentioned, it's a good time to put money to work because it's down, frankly. And if we're buying stocks because we have a 5 to 10 year plus horizon for that asset class, then now seems like a pretty good time when things are down, right? And it's so funny. I always tell people buy low, sell high, but when things go down, they don't want to buy. They want to sell. And maybe I shouldn't laugh, but it's just comical to me that like everyone knows, most everyone knows that mantra, but they don't want to follow it. They want to sell when things are down.
Right. And I think right now in this current environment, the current market we're seeing, I think this is when it pays to actually have a financial advisor that follows their plan, strips out emotion, and just goes straight ahead with the plan that was already put in place. So what we're doing here is exactly that. So I think that, we're going to see some times where you want to get out of the market when things are going down. You think it's going to continue to go down, but that's when you got to stay with your course and strip out the emotion.
Right. And you're right. That's when we earn, the price that our clients pay for us is, when the market's up, it's easy. They don't need us for anything. And a lot of people get overconfident and they actually go out there and start dabbling in stocks themselves and think they can do this, and it's not easy, right? And so, this is when you learn a lot. This is when it pays to have a trusted fiduciary on your side that's helping guide you through it. And the good news is our process knows these cycles are going to happen. Like we don't have an investment philosophy that doesn't have bear markets built into it. Like it has bear markets into it. And more importantly, our financial plans know that bad markets are going to happen. And so when they do happen, we just stick with our knitting and we continue with the process and we stay disciplined. So let's go to our third and final topic of today's show. So what are we doing about it? So I know we're not just sitting on our hands, right? Because I don't like it when advisors tell clients, just do nothing. No, what you said was stay disciplined to your process. So maybe you can kind of open the door a little bit and kind of behind the curtain at least and tell people, what are we doing? What is our process when markets are down?
Right. So when markets are down, most people, like we had just talked about, may even want to exit the market. We're actually looking to put some of that money to work, that excess money that clients have. We're looking to buy stocks when they're low, when their RSI drops below 30. That's something that we actually just did recently here. We bought some equity for clients because the market had dipped below. But yeah, we're going to continue with our plan. We're going to continue to buy when the markets are low. We're going to continue to avoid bringing emotion into things and just staying with our plan, in accordance with each client's financial plan.
Yeah, good, very good. So thank you. So you're right. So every client, it's like 99% have a financial plan that I work on or Corey works on with the planners, and then we take that plan and we basically, you guys align the investment strategy with that plan. And you talked about excess cash. So all the time we have bonds paying interest, stocks paying dividends. So most every client has a nice little cash buffer to begin with. And then they have some bonds that maybe are maturing or haven't come down in value as much, like as much as like if they have a 1-year treasury or something. We'll take that. And you mentioned RSI, which stands for Relative Strength Index. And that's a technical indicator. And what that tells us, and it's not perfect, but basically you mentioned that if it gets below 30, right? If it gets below 30 or at 30 or lower, that implies that a stock has been oversold, meaning that relative to its underlying, fundamentals or trade, just basically trading, I believe, and you can elaborate on this if you like, is that now it's recommending that may be a good opportunity to buy. So when that triggers, that's when we go in there and we buy. So we're not just buying all of the stocks. We'll buy specific stocks that we feel have come down in price too much. And do you want to elaborate, or did I explain that well, or is there something else there?
Yeah, I think you did a good job of elaborating on that. Yeah, the RSI basically looks at a certain period of time, how it's traded over that period of time. And once it gets below 30, it is over that period of time at one of the lowest levels. So it's a great time to go ahead and add some exposure to that certain equity.
Right, right. So again, there's no perfect indicator, but we feel like that's at least using math. And so it's a technical indicator. So we use fundamental analysis to kind of pick our stocks. And then we're using technical analysis as to when we buy and sell within those stocks. And so, you're working on that. You and Abby are basically locked in, monitoring that every single day for our clients. And when one of those triggers, you take some cash, if they have some excess cash, and we go and we buy shares when they're cheaper, with the whole hope that we're lowering that average price. So if you buy a stock at $100 and now unfortunately it's down to 80 and it hit that RSI trigger, well, we might buy, so we started with 100 shares, we might buy another 100 shares. Well, now your average price is only $90. So the stock doesn't need to get back up to 100 to make your money back. And that's the whole idea. It just needs to get back to 90. And so that's what we're trying to do here, in buying low and managing that all internally. Most importantly, as fiduciaries, which means we're legally obligated to do this in our client's best interest. And we're also not charging a commission or a fee to do it, right? We're doing it because we want to take this as an opportunity to set up their investment portfolio to hopefully recover that much quicker. Now, again, we're not claiming we know when that stock's going to go up or when the market's going to cool. We just know that according to technical analysis, it's a representation that that stock may be trading a little bit cheaper than it was, maybe a day ago or 6 months ago or whatever we're looking at there. Good. But you also mentioned, yeah, and again, most importantly, as part of this, I said that a lot this show, but also another important piece is that we don't want anything in the stock market that you're going to need to access in the next 5 years. So if you're pulling out distributions because you're retired or you have a major home purchase going on, ideally we want to have that money in bonds or cash. And now, unfortunately, the bond market's fluctuated a little bit as well. So that doesn't work perfectly always. But the idea is that those instruments, typically, the way we buy bonds, we typically buy investment grade bonds, are normally a little bit safer than the stock market. So if you have a shorter term goal, we want to make sure that we don't have that in the stock market. And then if you need 5,000 a month, 10,000 a month, we want to make sure we've got plenty of money in those cash and bonds, to help suffice for at least 5 years, ideally 10 years, but at least 5 years. Is there anything else on that? Is that?
No, I think that's great. Yeah, the positions we are purchasing, we have that 5-year outlook on those positions. So it's not ideal for a client to, want to take funds from those positions that, we're still have a great outlook on. So it's good to have that exposure to those corporate bonds and those treasuries, as a nice little buffer and cushion for when we are in times of turmoil like we are now. One thing I did want to add to what we are doing, and I guess it's not currently what we are doing, but it's something that we are keeping our eye on, is we will look to rebalance portfolio. So when the equities of a client's portfolio, when it breaches below 5% out of tolerance, we'll go ahead and sell some bonds and then go ahead and purchase those equities that are down. Now, as you had mentioned, the bond market has also seen a decline. So we haven't been able to really implement that quite yet, but it is something we're keeping an eye on. So we will be able to take advantage of those situations if they come about.
Yeah, good point. Good point. Yeah. So with rates going up and all the other uncertainty, bonds have come down also. So you're right. It hasn't really triggered a rebalance. So we're being a little bit more tactical within the bonds and the stocks. But you're right. If it hits that 5% tolerance, so if you're 50-50 and you become 45-55, we're going to go in there and we're going to rebalance it either way. If your stocks are up, we're going to go buy bonds. And if your bonds are up, we're going to go buy stocks. And that is really, I think, a very prudent way to manage money and helps you from getting too far over your skis in any one direction in there. So that's good. Yeah, thank you for bringing it up. That's a good point in there. And you also, I like what you said about, yeah, it's unfortunate. Obviously, when we go and we enter a position or buy a stock, and if it goes down right after we would buy it, some clients will say, well, are you going to sell that? And I'm like, well, that's a good point. No, because as long as fundamentally nothing's changed and we still feel good about the outlook, yeah, it's unfortunate that it's gone down, but that doesn't mean that in a year, 5 years, 10 years from now, that stock will ultimately, the thesis that we have planned for that position won't play out, right? So Some of our individual stocks are down quite a bit, but again, we review those and we monitor them. And if our opinion of them hasn't changed, if anything, we're going to buy more of them. We're not going to sell them. Good, good, good. Is there anything else? I think we've solved all the world's problems.
Yeah. I don't think so.
Good. So again, don't fight the Fed. When the Fed raises rates, it doesn't feel good at the time, but ultimately they're doing it for a reason. I think to your comment in the early 80s when they did it, I think that's when a lot of our clients remember inflation was way out of control. Mortgages were over 10%. And that's ultimately, I believe that 5% hike is probably what ultimately fixed inflation. It was very unpopular, and I think it sent the economy into a recession, if I remember correctly, but it had to happen or else inflation was just going to continue to be rampant. And so it's not a popular thing. And at least Jerome Powell is trying to juggle it a little bit better instead of ripping the Band-Aid there.
Right.
But you want to pay attention to what the Fed's doing. If you have some debt, you want to make sure that you know what's going on. If you're looking at buying a house, you want to understand what mortgage rates are doing. So again, it's even more of a reason to pay a little bit closer attention, because if the Fed keeps raising rates, I would expect mortgage rates to keep going up, right? I expect credit cards ultimately to probably start charging higher, and other loans out there. And hopefully you make more money in your savings account, or we can make more money in bonds also. And then again, the market, we both agree that we think it's going to be volatile. If we get good news, it should go up. If there's more uncertainty, it'll stay volatile. But hopefully as some of these variables get checked off the list, certainly once we have the midterm election, once we see what the Fed's going to do, once we have more earnings numbers, hopefully we get things going in a good direction and we get some stability and work our way up. And then again, we're sticking with our process. We're buying low, selling high. Clients can call us, they can email us, they can set up times to talk. I know you and Abby are available as well. So if they have questions about their portfolio, please don't hesitate to do that. But we're sticking with our process, right? We're going to be disciplined. I took a course at the University of Pennsylvania's Wharton School, so did Corey. You passed level 1 of CFA. You're also accredited asset management specialist. So is Abby. And so we've got the credentials. We've got the training that we're just going to continue to do what we feel works, and stick with that. And if a client ever has any question or wants to talk about it, we're certainly going to make ourselves available. To that end, what's the best way a client to get a hold of you, Matthew?
You can reach me at Navickas at Falcon Wealth Advisors. That is, I'll spell that for you because it's quite a last name. That's Navickas. Or if you'd like, you can give me a call at 913-326-1905.
Perfect. Yeah. So I know you're on the trading desk in there working away. You and Abby are doing that. But again, if a client needs you to take a time out because they've got a specific question, like I said, please feel free to do so. Email's best for me too, jake@falconwealthadvisors.com. Normally I schedule all of my meetings or callbacks, but we're happy to do that. I also have 2 financial planners, Matthew and Jake. We work as an ensemble team, as you're hearing here at Falcon Wealth Advisors. So really, if you have a question and someone else on the team or anybody on the team can answer it, we're going to make sure that gets answered so that you're not waiting on that. So good. So as we wrap up the show here, Matthew, you've got anything fun planned for this weekend, or?
I will be trying out the new restaurant in town called Ocean Prime. So I'm very excited about that. Heard a lot of great things. So I'm really looking forward to that.
Did you only hear that from me, or have other people said things?
No, I've heard it from you. And I've also heard it from some really, I would say, advocates of Capital Grille. And they said that Ocean Prime is right there with Capital Grille. So I'm looking forward to it. Yeah,
I agree. And I'm usually a huge Capital Grille fan, but Ocean's Prime, Rachel and I have been there, I think 2 or 3 times now, and we really enjoyed it. So highly recommend it. I know you're going to have fun with that. Hopefully we get some sunshine this weekend too. As the recording of this, it's been crazy, the weather. So, but anyways, yeah, same with me. I think I'm not going to Ocean's Prime, but I'm going to try to squeeze in some golf. I've got a client's daughter getting married this weekend, so I'm really excited to go to that wedding. Kentucky Derby's coming up, Mother's Day, got a lot, big weekend. So should be a lot of fun weekend. And again, thank all of you out there for tuning in. Matthew, thank you for joining me on the show. You have any other closing thoughts, or?
I guess a closing thought would be, the market has priced in things. I would say that I think the housing market has still yet to price in anything.
Gotcha.
So hopefully we'll see a pullback in the market for the housing market.
Right. We'll see that cool because you're probably looking
Yeah.
for a house, aren't you?
Yes.
So makes sense. Makes sense. Well, good. Well, again, thank you. That's a good point. And again, we'll continue to watch closely. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.